If we examine what's happened in the silver market, is central banks, and initially it's Russia, India, but India has made a very bold move, silver into their monetary system by allowing investors to use silver as collateral, introducing it into the banking system, and they furthermore doing it at a 10-to-1 ratio, 10 times less than 1 kilo of gold. We saw a move on copper futures from $4 up to $6, a 50% move in a very short period of time. If something were to be similarly introduced to silver, we could see $75 silver overnight.
In this insightful video, financial expert Shawn Khunkhun breaks down recent moves in the silver market and what they could mean for investors worldwide. Central banks, including Russia and India, are taking bold steps by integrating silver into their monetary systems. India has gone even further, allowing silver to be used as collateral in the banking sector at a 10-to-1 ratio compared to gold. We've already seen dramatic moves in other commodities like copper, surging from $4 to $6 in a short time. If silver experiences a similar adoption, it could potentially hit $75 almost overnight. Watch as the market dynamics and potential opportunities are explained in detail. Don't forget to like, subscribe, and turn on notifications for more market insights.
Investors are looking to protect themselves with silver and gold. And then if we examine what's happened in the silver market, is central banks, and initially it's Russia and it's India. But India has made a very bold move, and I made a post about this about a week or so ago. So if you go back to 2009, the Reserve Bank of India made a very large, substantial gold purchase, and this was done at an average price of about $1,000 an ounce gold in 2009. Now that purchase has aged very well. Why did they make that purchase back in 2009? It was to diversify against a falling US dollar. So the RBI, the Reserve Bank of India, has been spot on in their outlook and their conviction, and that purchase in gold marks that. Now, what did the RBI just announce? They announced that they're potentially looking at bringing silver into their monetary system by allowing investors to use silver as collateral, introducing it into the banking system, and they furthermore doing it at a 10-to-1 ratio, a 10-to-1 silver to gold ratio. 1 kilo of silver is worth 10 times less than 1 kilo of gold. So if you think about that now, David, we're in an environment in markets where paper markets dominate the price. In one day, you've got 2 billion ounces of silver trading hands in the paper market. However, we're only mining and recycling on an annual basis half of that amount, 1 billion ounces. Okay, so on a paper market, we're trading 2 times annual supply. And we're doing this at an 80-to-1 silver to gold ratio. So the RBI was right about gold in 2009. If they're right about silver, that implies a $400 silver price based on a 10-to-1 silver to gold ratio. India and China have had China never had a gold backed currency. They never had a golden age. They had a silver age, right? So the big demand for silver is from China, from India, from Russia, from the East. And they are acutely aware that over the last 100 years, as we've looked to electrify the world, there is no substitute for silver. It's the most conductive metal in the planet, right? Its use in electrification, in the military industrial complex is very significant and material. And because of that, in the last 100 years, post-industrial age, we've gone from using 90% as a monetary metal down to 50%. So we've got an growing industrial demand, which has led us to 200 million ounce a year deficits for the last 5 years. So I think the RBI is acutely aware of this, but the rationale is it because of the critical component. Like I was just looking at the Trump administration adopting silver as a critical mineral. Now, if they evoke Section 232 and apply tariffs like they've threatened to for copper, what did we see happen to the copper price in the beginning of summer? We saw a move on copper futures from $4 up to $6, a 50% move in a very short period of time. If something were to be similarly introduced to silver, we could see $75 silver overnight. What I was looking at was looking at an environment where I was convinced that from a gold to silver ratio standpoint, we could go to 20 to 1 to 15 to 1. So I was convinced that we were going to see much higher silver prices. And what I was trying to build was a business that went out and tried to build itself during a depression in the metals. And so as I did not see the larger producers invest in a pipeline of projects, the idea was get out through acquisitions, through good science, build a portfolio of assets that would one day become very, very attractive to a producer as they were looking to replace their mining pipeline. As they, every day a producer goes out, they deplete their mineral resources. So that was the idea. So $50 silver. Look, it was rewarding. It was rewarding that $50 silver occurred, but it's all relative. One of the things that happened after I came in as CEO was the pandemic print, where we increased the money supply by 25%. One of the things that I never factored in was this growing industrial demand, the fact that photovoltaics were going to take off, the fact that Samsung was going to make a battery for electric vehicles that used a kilo of silver. So I never factored in growing industrial usage. I was just banking on investors looking to gain exposure to silver as a hedge against, as the all-in sustaining costs to produce these metals go up, the metal prices need to stay ahead of that.
In this in-depth discussion, financial expert Shawn Khunkhun analyzes the evolving silver market and its potential impact on global investors. Central banks, particularly in India and Russia, are exploring bold moves by integrating silver into their monetary systems, with India allowing silver to be used as collateral at a 10 to 1 silver to gold ratio. Historical context shows the Reserve Bank of India's gold purchases in 2009 were highly profitable, and similar strategies could drive silver prices dramatically higher. With growing industrial demand, annual deficits, and the metal's critical role in electrification and technology, silver's value could surge. Recent commodity trends like copper's rapid rise highlight the potential for sudden market shifts. Shawn examines how these factors could influence silver pricing and investor strategy. Let's get into the interview.
When we compare this recent run to and through 50 and the two previous runs to $50. So if we examine the move, 1979, 1980, that was a move where silver had dramatically moved in a very, very short period of time, similar to the move it made in April of 2011, right? And they were moves that were not sustainable. Whereas this move, it's been a lot more gradual, right? So it's been a gradual increase. And it's also important to note, David, that, what 50 nominal dollars means today versus what 50 nominal dollars meant in 2011 or in 1980 are drastically different. And, one of the relative values that I look to point at is when I took over as CEO at Dolly Varden, I would need 64,000 ounces of silver to purchase the average home in Vancouver. That was in the spring of 2020. Today, I only need 15,000 ounces of silver, not 64,000 ounces. So I think what's changed is, with COVID, with the expansion of the money supply growing by 25% during the pandemic, it requires that many more dollars to go after these hard assets, including silver. It's a great question. And one thing I want to point out, as you had that longer term chart that
Yeah.
predated the 1980 price spike to $50, when one of the Dolly Varden mines was operating, 1959 was the last year the Torbert mine operated. Silver was 85 cents an ounce. So the move from, call it 1960 to 1980, if you were to take that same move from our base, that would imply, using a $16 base, $800 an ounce. So to try to capture the type of move we had from 1960 to 1980 during this next leg up in the bull market, it would equate to an $800 silver price. Well, look, I think there's two different conversations. There's a gold conversation and a silver conversation. On the gold side, what you had during the bear market, which really started in around 2012, 2013, and lasted up until about a year or two ago, you saw mega mergers. You saw, Barrick and Randgold come together, Newmont and Goldcorp. You saw Agnico Eagle consolidate and become the largest, gold mining company in the sector at $120 billion valuation. So I think as we look forward to M&A, because you had these mega mergers, M&A is going to be different now, where those companies are going to rank what they describe as tier one to their business and start selling what were the building blocks to their portfolios and start divesting them to smaller entities. So I think M&A is going to be quite nuanced. It's a totally different conversation in the silver space, because in the silver space, again, there are only 10 primary silver producers. And if we examine these silver producers, and something very topical is Coeur. Coeur just announced last week that they're buying New Gold. Well, after the purchase of New Gold, Coeur's revenue that is silver centric moves down to about 25%. So how we even define what is a primary silver company, if we look at the Pan American example, where like 28% of Pan American's revenues are silver, there is really only one silver centric entity, and that's First Majestic, where 55% of their revenues are derived directly from silver. So silver is a tough space because it's so scarce and so rare, and because it's predominantly produced as a byproduct. But what we have seen is, in a space that used to cover 13 companies, is now contracted down to 10. And one could argue that some of those silver-centric companies are now, becoming gold centric. And so it's become even smaller and smaller and smaller. And so as investors start getting priced out of gold opportunities with a $4,000 gold price, as the gold market's becoming more and more expensive, and as retail investors buy silver and the demand for silver increases, and that's why we've seen silver prices outpace the ascent of gold, it's going to be even more difficult, and it's going to make the silver-centric opportunities even more valuable.
In this deep dive, Shawn Khunkhun explores how the silver market is evolving compared to historical runs and its growing significance for investors. Unlike the rapid spikes of 1980 and 2011, the current silver move has been more gradual but underpinned by major shifts in global finance, COVID-driven monetary expansion, and industrial demand. With fewer primary silver producers and retail investors increasingly priced out of gold, silver-centric opportunities are becoming rarer and more valuable. Historical context shows the potential for unprecedented gains, with comparisons suggesting significant upside if similar market dynamics continue. This analysis highlights why silver may not only act as a hedge but also present extraordinary investment potential in the current market cycle. Don't miss out, subscribe, and turn on notifications for more market insights.